Welcome to this week's episode of Jonathan on Money. This is episode number 154. Well, I hope everyone's doing well. This podcast will drop the morning before Pesach starts. Normally, my podcasts drop on Wednesday, but I did want to get this one out before Yontif, and I'm sure many listeners are very busy, but I figured I'd start by offering one thought as it relates to the Seder and, of course, tie into investing as well. And what I want to discuss is what the Pesach Seder teaches us about the best investment of all. And it's a pretty bold statement to call something the best investment, but bear with me on this. So, as folks who have been consuming my content for a while know, Pesach's my favorite holiday. And this is because it's a living, breathing expression of what Judaism is all about. Each year, as families gather around the Seder table, tradition, history, faith, and identity converge into one powerful experience. It's a moment when we don't just remember the Exodus, we actively transmit its lessons to the next generation. And for me, that act of transmission highlights the greatest investment I make every year, which is my children's yeshiva education. In many frum communities, yeshiva tuition is one of the largest financial commitments families shoulder. It's stressful, it's demanding, and it often feels overwhelming. I've written before and I've spoken about the need for systematic improvement, and that remains true. But Pesach reminds us why this investment matters so deeply. A yeshiva education is not simply about academics. It's about shaping identity, instilling values, and giving children a framework to understand who they are and where they come from. Throughout the year, we see glimpses of this. A Dvar Torah at the Shabbos table, a halachic discussion, a story about the Parsha. But at the Seder, everything really does come together. The symbolism, the questions, the storytelling, the intergenerational dialogue. It all reveals the return on investment in real time. When a child confidently explains a passage of the Haggadah or asks a thoughtful question about Yetziat Mitzrayim, the Exodus of Egypt, you can see the chain of transmission alive and thriving. A yeshiva education also builds intellectual rigor. The discipline of Torah study develops critical thinking, persistence, and the ability to grapple with complexity. And these are skills that extend far beyond school. Speaking personally, these abilities weren't formed when I went to business school, they're forged in yeshiva. Equally important is the ethical framework students absorb. In a world where moral lines often blur, grounding in halacha, midot, and community responsibility provides a compass that guides personal and professional life. This foundation feels especially urgent today as we recite Vihi Sha'amda. In every generation, they rise up to destroy us. I'm sure many people are familiar with that verse. The rise in anti Semitism is a stark reminder that resilience is part of our identity, and Jewish education is central to that resilience. Ultimately, the return on investment here isn't measured in dollars or percentage terms. It's measured in identity, values, continuity, and the confidence that the next generation is prepared to carry our story forward. And Pesach reminds us that while challenges evolve, the foundation that sustains us remains constant. And investing in Jewish education is one of the most powerful ways to secure our future. That was my one Pesach idea to share with folks as they celebrate the Seder tonight. In other news, don't forget to buy my book, D's for Diversification, the ABCs of Personal Finance, which is now available at Amazon or jonathanonmoney.com. Makes an excellent Afikoman present. And finally, before jumping into this week's episode, I'd like to share that my upcoming live spring webinar series will begin this Thursday, April 16th at 8:30 a.m., featuring Av Sinensky of Falcon Rappaport and Berkman LLP, based in Long Island, New York. And he's going to be speaking about when the family is in the business, why you need a real partnership agreement, such an important topic. This program will also be for CLE and CPE credit, available for accountants and attorneys based in New York and New Jersey. And I'll be sure to include the registration information in the show notes to this episode. Okay, now for today's agenda. My talking points this week are going to discuss ways to overcome the risks of retiring into a down stock market, which we're right in the middle of right now. Our quote this week is from Tim Ferriss on losing sight of what money is really for. I'll spend the last half of the episode answering listeners' questions, including how much of one's assets should go into guaranteed income annuity. And finally, we're going to end with an actual idea to implement your investing life, where I discuss one of the best finance books that I've read in a while. With that, let's jump into this week's talking points. So, the current war in Iran and the resulting turbulence in the global financial markets have understandably made many investors uneasy. Headlines about geopolitical instability and market volatility can rattle even the most disciplined savers. It is a uniquely difficult challenge for individuals who are approaching retirement. After working for 4 decades or more, they are eager to step away from their careers and begin the next phase of life. For them, a conflict on the other side of the world isn't necessarily a reason to postpone retirement. However, market downturns can be especially dangerous during the early years of retirement when portfolios are most vulnerable to what is known as sequence of returns risk. If retirees are forced to withdraw funds from a declining portfolio, those losses become locked in and can permanently impair long-term financial security. Preparing investors and clients and families to retire into uncertain or declining markets requires thoughtful planning and flexibility. The strategies used often depend where someone is in their retirement planning cycle. Individuals who are still working typically have more options available to them, while those who are already retired may need to rely on different tools. Today, I'm going to share 7 strategies I discuss with clients in my practice when markets become turbulent, with the goal of ensuring the client can remain retired without significant financial stress. And first, this is something I mention often. Build a cash or short-term bond buffer. I often encourage clients who are still working but are approaching retirement to begin increasing the amount of cash they hold in their checking accounts or in short duration fixed income investments. The goal is to avoid withdrawing money from the investment portfolio when markets are falling. Maintaining 1 to 3 years worth of spending in cash or short-term bonds allows retirees to fund their expenses without selling equities at depressed prices. When markets eventually recover, those investments remain intact and can participate in the rebound. Next is to consider accelerating Social Security benefits. Conventional retirement planning wisdom generally encourages delaying Social Security benefits until full retirement age or even till age 70 to maximize guaranteed income stream. Larger monthly payouts later in life can provide valuable protection against longevity. However, when someone's retiring during a prolonged market downturn, it's worth running the numbers to see whether claiming benefits earlier could serve as a bridge. By relying more heavily on Social Security income for the first few years of retirement, clients may be able to reduce withdrawals from their investment portfolio while markets are depressed. This approach isn't ideal for everyone, but in certain circumstances, it can help mitigate sequence of returns risk and preserve, I should say, long-term assets. Next is what's called income flooring. This is another concept that can be extremely helpful during volatile periods. The idea behind income flooring is to ensure that essential expenses such as housing, food, and healthcare are covered by reliable sources of income. These sources might include Social Security, pension, or annuities. When core expenses are funded by guaranteed income streams, the investment portfolio can be used primarily for discretionary spending such as travel, entertainment, or gifts. Personally, I tend to be cautious when recommending annuities because of their complexity and cost. That said, a single premium immediate annuity, often referred to as a SPIA, may make sense for certain clients as part of a broader retirement income strategy. Allocating a portion of assets to a SPIA can provide a predictable income stream that covers basic living expenses regardless of market conditions. Knowing that essential expenses are secure can make it much easier for retirees to remain calm and financially stable during periods of market volatility. Another idea is Roth conversion opportunities. One strategy worth considering is performing partial Roth conversions while asset values are temporarily depressed. When investors convert funds from a traditional IRA to a Roth IRA, they must pay taxes on the amount converted. If markets have declined, however, those taxes are calculated on lower account values. Should the investments later recover within the Roth account, the growth becomes tax free. For clients who are still employed and have sufficient cash available to pay the tax bill, a market downturn may represent an ideal time to execute these conversions. Years later, when withdrawals from the Roth IRA are tax free, the downturn that once caused anxiety may ultimately look like a strategic opportunity. You can also explore continuing to work. Even modest income during the early years of retirement can dramatically reduce pressure on an investment portfolio. This doesn't necessarily mean abandoning retirement altogether. In many cases, delaying retirement by 6 months to a year or transitioning to part time work can provide significant financial flexibility. The current geopolitical situation may resolve quickly, or it could create prolonged market instability. Continuing to earn income from wages for a short period of time allows soon to be retirees to wait out volatility and avoid withdrawing money from their portfolios. A small adjustment to retirement timing can sometimes make a very large difference in long term outcomes. And next is flexible spending. Spending flexibly is one of the most powerful tools available to folks in retirement. Many retirees allow traditional strategy of withdrawing a fixed inflation adjusted percentage of their portfolio each year, which is often referred to as the 4% rule. While this framework can work well over long periods, it may be too rigid during market downturns. Instead, I encourage clients to adopt a more flexible withdrawal strategy. When markets decline significantly, temporarily reducing spending by 5 to 10% can meaningfully improve the sustainability of the portfolio. These reductions don't need to be permanent. They simply provide breathing room while markets recover. And finally, there's a strategic portfolio rebalancing. When stocks fall relative to bonds, disciplined rebalancing allows investors to purchase equities at lower prices while maintaining the portfolio's intended risk profile. In some cases, broad market declines can provide an opportunity to reposition portfolios that may have become overly concentrated. For example, a client who has long wanted to reduce a large position in a single stock might use a market sell off to trim that position. This can help de risk their portfolio by reinvesting the proceeds into more diversified investments. Lower asset prices may also result in reduced capital gains taxes compared with selling at market highs. In this way, volatility can create opportunities to improve portfolio structure for the long term. A key truth about retirement planning is that the first 5 to 10 years of retirement matter the most. If a portfolio can successfully navigate this early period without excessive withdrawals during major market declines, the probability of long term financial success increases significantly. For retirees and those approaching retirement, uncertainty surrounding geopolitical events and market volatility can feel unsettling. With careful planning, flexibility, and thoughtful adjustments, it is entirely possible to stay on track even when markets are less than cooperative. The goal isn't to predict every market movement, but to build a strategy resilient enough to withstand them. Okay, those are the talking points this week. As a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Tim Ferriss. For those who don't know, Tim Ferriss is an American author, entrepreneur, investor, and podcaster, best known for his best-selling 4-hour book series and his influential long-form interview podcast called The Tim Ferriss Show. Ferriss grew up with health challenges that sparked an early fascination with self-improvement. Ferriss began his career in sales, but soon founded Brain Quicken, an online supplement company. He later sold to a private equity firm. That entrepreneurial experience became the basis of his breakout book, The 4-Hour Work Week, which I read and is excellent, which popularized lifestyle design, automation, and unconventional approaches to productivity. He followed it with The 4-Hour Body and The 4-Hour Chef, cementing his reputation as a human guinea pig who tests extreme experiments in performance, health, and learning. Beyond writing, Ferriss became a prominent angel investor and startup advisor, backing companies such as Uber, Shopify, Duolingo, and TaskRabbit. Today, Ferriss is widely recognized for The Tim Ferriss Show, one of the world's most downloaded podcasts, where he interviews top performers across businesses, sports, science, and the arts to extract practical tools and habits. He also supports research into psychedelic-assisted therapies and has launched his own audiobook publishing. Last week, Ferriss posted on the following on X, and I thought it was important. He said, if we assume the point of investing is ultimately to improve your quality of life and the quality of life of those you care about, investments that consistently add stress over long periods of time probably don't make sense. Money is traded for things or experiences that catalyst certain feelings. If your investments are generating the opposite spectrum of feelings, it might be time to reassess. It's easy to miss the forest for the trees. Money is a means, not an end, and in the end, most things matter very, very little. Do what helps you sleep at night and wake up with a low heart rate. To me, those are the hallmarks of a world-class investor who gets the big picture. And I like this quote because the core message is that if an investment consistently erodes your peace of mind, it's not serving its real purpose. Money is ultimately a tool to improve your quality of life and the lives of the people you care about. If the way you invest creates chronic stress, anxiety, or emotional turbulence, then the investment, no matter how promising on paper, is misaligned with your true goal. In this time of year of reflection, make sure that your money isn't causing you more problems and it's helping you improve your life and relieve stress. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me and it may be answered in a future episode. Okay, first question. You seem pretty negative on both crypto and private equity. What do you think is worse? Crypto is worse and more nonsensical, and it's not even close. In a nutshell, private equity is investing involves just buying an ownership stake in private companies to improve operations, to grow value, and eventually sell it for a profit. Investors typically commit capital long term, aiming for high returns through strategic management, restructuring, or expansion outside public stock market. Investing in businesses is actually investing. The issue I have with PE is when people make unrealistic or baseless return assumptions and when they say it's a sensible investment for all investors. Both of these areas are triggering for me. When it comes to performance, many PE managers neglect to factor in the layers of fees, which will undoubtedly eat into the returns. They also are a bit too optimistic about the return assumptions. Every PE manager will state that they're targeting mid-teen returns even before fees is extremely unlikely to achieve consistently. So, given the extremely high fees and lack of consistency and high returns, most investors should question what benefit PE has within their portfolio that traditional public equities don't provide. On the other hand, crypto is not a business. It's not a commodity. It's not a currency. Its values derive exclusively from someone buying it for a higher price. If you think back to the heyday of crypto, which was right around COVID, many of those cryptocurrencies are not spoken about anymore because they plummeted in value. Sure, Bitcoin is left and has done well for some people, not factoring in the most recent 50% drop. Maybe there are a couple of others. The question is, what is the practical utility of something like Bitcoin that would make you want to buy it? I can't figure it out. Um, is it, it's for this reason why crypto makes far less sense to me than private equity. But what about your friend who bought Bitcoin and it went up in value? Remember, getting lucky is not a reliable way to build wealth. Stick to something boring and sensible. This is the strategy that is likely to get you ostracized from any legit kiddish club. Next question. I'm 65 and have $250,000 in my 401k. An advisor suggested putting it all into an annuity promising a 10% return. Now what? Forget about the return assumptions here. Does the 250k in your 401k represent 20% or less of your assets? If not, then the word annuity shouldn't be mentioned in a financial planning discussion. It's too large of a percentage of your assets to be locked up in an expensive product that will achieve mediocre investment returns relative to the market, regardless of what your guy says. That is totally illiquid and offers no additional tax benefit since it's already in a retirement account. The truth is, most annuities are created to be sold. They usually don't make sense for most investors. In the nearly 20 years I've been doing this, I can count on one hand how often purchasing an annuity actually made sense for a client. Your advisor is probably employed by one of the major insurance companies and gets a juicy commission for selling an annuity. You should get a second opinion from someone who isn't just looking to meet their sales quota for the year. Next question. If growth stocks and private equity have the highest returns, why not invest exclusively in that area of the market? They do? Prove it. This sounds like kiddish club advice after too many shots of tequila and bowls of cello. And by the way, how did tequila become the hottest drink at a kiddish club these days? Whatever happened to old school shivas? In my view, we need to make kiddushim Hamish again. That's a great slogan, by the way. In other news, large technology companies, which can be classified as growth stocks, have done well over the past decade and a half. That doesn't mean that all growth stocks have performed so well, and it certainly doesn't mean that all growth stocks will do well in the future. Private equity is even trickier because the returns are not transparent and there is a much larger disparity between the best performing funds and the worst performing funds. This type of disparity is not the case in public markets. Also, good returns in private equity in any previous time period does not guarantee the same returns in the future. The path to success with investing is through proper diversification and a process of adding money to your portfolio on a regular basis. The other option is to get lucky, but luck isn't a strategy. Remember to always stay diversified, my friends. When will you be sharing your 2026 mid-year market predictions? Mid-year? I'll do it right now. The market will go, one, the market will go up. Two, the market will go down. Three, bad things will happen. Four, good things will happen, but few people will talk about it. Five, a friend in shul or your broke brother-in-law will have a great deal for you. Six, that same friend or brother-in-law won't discuss the deal ever again because he lost his shirt. Seven, if you diversify and add money on a regular basis and stick with your strategy, you'll be able to be better shape in the future than people who don't implement this strategy. The difference between my forecasts and those of all major Wall Street firms is my predictions will actually come to fruition. Their forecasts are pulled out of their tush and likely won't. Feel free to follow me at Jonathan on Money across social media platforms for more of my thought leadership and market commentary. Last question for this week. Would you take $1 million a year to exclusively be the financial advisor for a client I work with who has $400 million? No. Here's why. One, you'd be underpaying me. My fee on an account that size is between 0.35 to 0.4%, depending on a few factors. So your client would be paying me less than my going rate. Why would I give preferential fees to this family? They aren't even the wealthiest people I've met, and certainly probably not the coolest. Despite what it seems, I'm not running a charity. Two, this is the key point. I currently have diversified client base, different levels of wealth, geographies, ages, stages of the career, industries, etc. The only area where I'm concentrated is I work mostly with Jewish people. That's the type of folks that I attract. If a client becomes disgruntled and they leave to another firm that is inferior to mine, it really makes no difference to me from a business or revenue perspective. If I have one large client who becomes disgruntled, then I have no revenue and no clients anymore. It's a ridiculous business decision. I wouldn't fire all my clients and take on one larger client even if they paid me double the market rate. It's just dumb. However, if your client wants to be one of the exclusive families that I do work with, then they can feel free to reach out. I'll be happy to discuss my proprietary process for wealth planning across multiple generations. Just have them shoot me an email. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me and perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I like to end with a timely national idea that listeners can implement to their own financial lives. And today's timely idea is to read the book The Money Kings, the epic story of Jewish immigrants who transformed Wall Street and shaped modern America by Daniel Shenkman. Jews have had a major impact on all areas of American life, and finance is just one of them. And this book, which I just finished, traces the rise of several Jewish immigrant families who helped build modern American finance. It begins in the 1830s and 1840s when newcomers like Joseph Seligman, the Lehman Brothers, Solomon Loeb, and Marcus Goldman arrived in the United States with almost nothing. Starting as peddlers and small-town shopkeepers, they gradually moved into buying merchants' IOUs, then got into banking, ultimately founding powerhouse firms such as Goldman Sachs, Lehman Brothers, Kuhn Loeb, and J&W Seligman. As these families expand their businesses, they are cross paths with titans of the Gilded Age, including J.P. Morgan, E.H. Harriman, Jay Gould, and others. Their banks played a central role in transforming America from a struggling debtor nation into an industrial and financial superpower. They helped finance railroads. They underwrote major corporations like General Motors, Macy's, and Sears, and fueled the country's rapid economic growth. But the story's not only about finance, it's also about identity, belonging, and the immigrant experience. These Jewish bankers navigated a deeply anti-Semitic American upper class while also wrestling with their own ties to Germany, their Jewish heritage, and the emerging Zionist movement. While it seems like this book could have been written today on similar topics. Their success shaped not only Wall Street, but also the lives of millions of Eastern European Jews that later arrived in America. The book manages to weave these threads into a sweeping narrative of ambition, adversity, and transformation, showing how a handful of determined immigrants helped define both American capitalism and the modern Jewish American history. It was an informative read, important American history, and it's just another reason to be proud to be a member of the tribe. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.